Welcome back to our next installment on our market update video series. I'm Danielle Kosick, and I'm here today with Rob Kosick to discuss the current trends affecting the management of your investment portfolio.
Thank you, Danielle. I join with all of our clients and all of our employees and welcome you back to Ohio.
Thank you.
I also want to take a quick moment to put out a congratulations to Matthew Ringel. Matthew has been a team member at DLAC Wealth Advisors since 2016. He started as an intern, and he has just completed his graduate work at the University of Cincinnati in finance and investments. Congratulations, Matthew. Initially today, I want to take a moment to reflect and thank you for the value that I actually get from all of you in the meetings that we have. It's the end of another school year, so I'm thinking about all of my clients' children who are now graduating high school and college, and their accomplishments, which naturally draws me back to all our conversations about planning for education of kids and working together to make these children's dreams a reality. And to be honest, these are dreams that we share with our children. The value to you as clients in these conversations hopefully has been your financial education, the management of costs, and the maximization of efficiencies. The value to me is that all you who are raising or have raised fantastic kids, and the amount that I've learned from each of you in each of these interactions. I not only have a child who's now going to be a junior in college, I also have a 5-year-old. And believe me, I'm using the things that I've learned in these meetings from each of you as you have helped your kids reach their greatest potential.
I wasn't hearing a lot about the markets while I was at school, but now that I'm back in the office, I've been hearing a lot about the volatility of the markets. Could you tell us a little more about this?
Well, remember, the norm for stocks is volatility, so short-term price swings are to be expected. That said, here are some timely points to consider. Late last year, we put out a video, and I was very upfront at that point to try to explain that I believed, and it came through to fruition, is that the significant drop in the market in December was due to interest rates rising, and interest rates rising rather rapidly. High interest rates are bad for stocks. This time around, I'd have to be honest, is that the volatility is being driven more by trade wars with China and now Mexico. Okay? And when I say the trade war, I mean really the lack of resolution thereof. But just as much, my concern long term is some of the pressure that's being put on pushing the dollar consistently up and what that could do, to our exports and the momentum that we get on a global scale from that point. So one is the noise. The noise is coming from the trade wars. And what that can lead to is the most precious commodity the market relies upon. And that is consumer, small business, and corporate sentiment. So many decisions ultimately are made by consumers, whether it's the individual or the corporation, and the spending thereof to either take care of your household, but on a corporate scale, more of future purchases and investments, and the impact and the significant impact they can have on the economy. So that's sort of a wild card out there that I concern myself and I give thought to on a continual basis. Further, Treasury yield spreads might be read as increasing the likelihood that we can see a recession in the near term. What we're having is a flattening of the yield curve. I'd honestly put the chances of a near-term recession somewhat lower, but at that point and said, I'm sure we'll talk a little bit more to that later in today's discussion.
What is the bond market saying? Which I have heard you often say this is where the smart money trades.
Okay, the yield curve is flattening without question. So what this chart is telling you is this. Every recession we've seen in the past 40 years has been prefaced by a flattening of the yield curve. But flattening of the yield curve does not necessarily indicate a recession is imminent. Take, for example, 1984, 86, 94, 98, even 2005. The yields seem to often do head fakes, and recessions can lag between 2 and 9 years based upon this measure. Is this time the yield curve flattening because of negative interest rates around the rest of the developed world? Maybe. And that would not be a sign of an imminent recession here in the States. So is there further downside potential from here? Certainly. Where does the market go if good news outweighs bad news? Up. With all that being said, let's all in unison state the name and or names of the historically greatest market timers. Why speak to all this then? Well, it's fun, and it matters to me from an entry and exit point on trades. What's much more important in allocation of a client's investments is, one, know your risk. And use significant market moves to add or extract money from the market for two reasons. If appropriate, to the opposite direction to what your stomach is saying. Remember, the only rule of investing that matters is buy low and sell high. The second is, as you get closer to needing money, reallocate to more conservative, liquid positions at high points in the market, as we spoke to in great depth 18 months ago.
Of the three components that you have shared that drive your investment decisions, those being valuations, economic conditions, and momentum, I've been hearing the least about momentum. Tell us, how do you plan on incorporating momentum into your investment decisions?
Well, that's a great question. As we've covered in probably a number of past discussions and videos and newsletters over probably the past 12 months, if not 24 months, is there, in my view, is a massive dislocation in valuation between growth and value and between U.S. and international stocks, which is undeniable as there's been a massive dislocation in performance between those segments. However, we've not made our big move to take advantage of such as of yet, because those areas of most potential still lack the momentum behind those strategies. And momentum means in our industry is don't catch a falling knife, meaning something's going down every day. Don't think you're the hero and you're going to stop it from falling. And if something is going up and has become overvalued, doesn't necessarily mean that it automatically becomes a good target to sell. The number one important variable in these types of decisions is valuations, and that dynamic is in place. However, if you run too quickly into ideas, momentum can work seriously against you, even if you are right in the end about valuations and the expected reversion to the mean. We could feel like we are throwing good money at bad and could represent a short-term hit to your performance with still the intent of getting quality long-term performance. So that's really where momentum comes in, is sort of knowing your entry and exit points and trying to do your best to not get fired along the way because you're holding too strong a conviction to what valuations are saying at a given point in time. Where I thought today cycles would run quicker, they're actually lasting much longer. From a sector perspective, as most of you know, truly interests me. We have sort of an interesting dynamic which will really come to light maybe with the next significant downturn. Because over the past 10 years, think about it, it's just been a little bit more than 10 years since the market hit its bottom in 2009. We've had this period where the market's gone up, but defensive stocks have become about as expensive as any other component of the market. It's as if everybody was trying to stay invested, but trying to stay invested within some more conservative areas. So you have things like utilities and staples that, although they've underperformed over the past 10 years versus the S&P 500, they've gotten to be extremely expensive. Why? Their lack of earnings growth potential. On the other hand, transportation, biotech, financials are relatively inexpensive in my view, yet have been hit in the short term by Boeing, the flat yield curve, and by headwinds to drug pricing. Long term, I expect these sectors to have their opportunity to outperform. But once again, you need some momentum before really that conviction comes through.
Everyone knows there is no such thing as par value maturity of a stock, yet all bonds have par value. I understand this is a concept you're using to better protect your clients. Could you tell us a little more about this?
Great question. In a very simple sense, bonds are considered to be the insurance of a portfolio, tending to be more conservative than stock investments and also tending to have some amount of negative correlation to stocks, meaning they won't necessarily always go in the same direction, or if stocks drop dramatically, they in turn maybe could even see in certain types of bonds go up under said environment. To get more specific to your question, when I buy a bond, I know what the SEC yield is. What that means is if that bond or that groupings of bonds has a maturity, then I know what my expected rate of return will be from buying point until maturity point. As you noted, of course, there's no such thing like that with stocks. Caveat, what is not taken into account in that expected return is that said bond could potentially default. So that will always be a consideration in determining whether to expect the SEC yield or what could be the yield to worst in my bond purchase. The risk areas of bonds over the past 15 years, and when I use the word risk areas, that could be floating rate bonds, that could be preferred stocks. A lot of people, and the heaviest component of that will be known as junk bonds. In the past 15 years, we've had periods where these types of bonds have yielded below 5%, and periods where they've yielded far above 10%. So in a very simple sense, if your yield to maturity, which is an annual expected return, is above 10% at one given point in time and it's below 5% at another given point in time, I can really measure out the risk versus opportunity. So right now, in my view, the risk far outweighs the opportunity within these types of bonds. So I look at my responsibility right now within my clients' bond portfolios more so about not losing them money. And I care about that a lot more than what kind of yield am I going to get. Because as the charts that I look at and what you're seeing here will go through periods where that spread widens dramatically. It widens dramatically and your opportunity could significantly outweigh your risk, which means there could be another period of time where I can buy into the components of the bond market. And if we get no defaults within that component, that our expected annual rate of return is greater than 10% per year. So I guess that term that I mentioned, default, could scare a lot of people. But historic defaults on high yields, are in the 2 to 3% range. So if I'm getting 10, 11% and 2% of my bonds mature, 2% of my bonds default or 3% of my bonds default, simple math could tell you that I still could be making close to double digits per year. You know what? Not right now, though.
Thank you. We appreciate your insights today. And from all of us here at DLAC Wealth Advisors, have a safe and fun summer. And we thank you for the trust you've put into our organization.